Welcome to The Explainer. Today, we're unpacking SEI Investments Company's, let's be honest, pretty data-heavy Q2 2026 earnings report. We're going to reveal the exact strategies that drove this absolute record-breaker of a quarter. If you've been following fintech or asset management lately, you've probably seen that SEI has been on this really long journey of structural and operational changes. Well, today we're looking at the hard numbers that prove this massive transformation is finally paying off. And I mean paying off in a major way. Okay, let's jump right in with a quote from CEO Ryan Hickey. This perfectly anchors our whole narrative today because it gives us the why behind all these numbers. He basically says that these record-setting results are direct evidence that the strategic shifts they've made over the last 4 years are finally translating into real performance. So this isn't just some lucky quarter, right? It's the culmination of super deliberate capital allocation and a really focused evolution of what they offer. So here's our roadmap for this explainer. First, we'll look at that record Q2 2026 performance. Then we'll break down the business segments, check out sales momentum and assets, dive into margin expansion and profitability, and finally wrap things up with their capital allocation strategy. All right, Section 1, record Q2 2026 performance. We're going to start right with the bottom line up front, because honestly, the headline metrics from this quarter are just absolutely staggering. Now, what really stands out here is the sheer scale of their adjusted earnings per share growth. It jumped an incredible 38% year over year to $1.66. This metric alone really shows the true earnings power of SEI's business model finally clicking into high gear. It's a 1-2 punch driven by both revenue growth and, as we'll see later, some very strategic share reduction. And the top-line strength is just as impressive. Consolidated revenues jumped 15% to hit a massive $641.6 million. To put that into perspective for us, they essentially added a whopping $82 million in revenue compared to the exact same quarter last year. That is a massive leap. Taking a quick look at the actual consolidated overview from the press release, you can visibly see how these high-level beats set the stage for a structurally sound, record-breaking quarter. I mean, just look across the board, from the 36% adjusted income from operations growth right down to the raw volume of top-line sales. Those operational changes Ryan Hick mentioned, they are systematically improving the core financials from top to bottom. Moving right along to Section 2, segment-by-segment breakdown. Let's lift the hood and see how this builds across SEI's specific business segments, so we can find out where the real operational wins are actually happening. This breakdown is fascinating. When we isolate exactly which segments are driving the most revenue and operating profit, the sheer scale of the investment managers division really stands out. At $227.6 million in revenue and a 40% operating margin, it absolutely leads the pack. But hey, don't overlook private banks at $156.8 million or investment advisors coming in hot at $177.8 million with a stellar 42% margin. And institutional investors, they clocked in with a highly efficient 47% margin. Just solid numbers all around. So what's the secret sauce? The crucial point is why these segments succeeded. And really, it comes down to catalysts like major platform conversions for private banks and a seriously surging demand for alternative investments. They are successfully moving clients from their legacy Trust 3000 platform over to the modern SEI Wealth platform. Plus, get this, about 3/4 of the sales events in that massive investment manager segment came directly from alternative investments. That's a huge trend right there. The investment advisors segment definitely deserves its own spotlight too. They printed a 30% revenue jump, which was mostly fueled by higher market values and the strategic value from their Stratos acquisition. But what's really incredible to me is that even if you completely exclude Stratos from the math, the advisors segment's margins still increased by over 3 percentage points year over year. All right, Section 3, sales momentum and assets. Now we need to look at the actual sales pipeline and underlying asset bases. Why? Because we want to understand if this growth is actually sustainable for the long haul. Well, following a record first quarter of $67 million, SEI secured another $43.5 million in net sales events. This proves the durability and, more importantly, the repeatability of their recent business activity. Bringing their year-to-date sales events to over $110 million really shows us that this momentum isn't just some one-off fluke, It's a persistent, recurring trend. That massive sales engine, combined with some strong market appreciation, has pushed their total assets under management up 9.5% to roughly $606.7 billion. Just wrap your head around that. That is a staggering pool of capital. When you actually factor in assets under administration and advisement across all their divisions, you realize SEI is interacting with approximately $2.1 trillion globally. $2.1 trillion. That really highlights their massive footprint in this industry. We also absolutely have to highlight the LSV asset management arm here. They single-handedly secured $2 billion of net inflows, which was largely thanks to a major new client mandate. Combined with market gains, total LSV assets surged by nearly $17 billion in just this quarter alone. That clearly demonstrates that their asset management capabilities remain incredibly competitive, even in a super crowded market. So generating top-line sales is great and all, but let's dive into Section 4, Margin Expansion and Profitability. This is where we see how SEI is actually translating all that revenue into expanded profitability. Comparing the U.S. GAAP versus adjusted non-GAAP operating margins reveals a whole lot about their efficiency. Their disciplined expense controls are pushing true operational profitability up to an impressive 32%. And get this, that is actually up a full 5 percentage points from Q2 of last year. This exact dynamic is what we call true enterprise leverage. Basically, it means that even though they're continuing to invest in future capabilities, SEI's revenue growth is now comfortably outpacing its expenses. Think about it this way. Their revenue increased by $82 million, while expenses only rose by $33.6 million. Their prior sales successes are actively converting into revenue, and all that disciplined expense control is translating directly into a much stronger bottom line. And finally, Section 5, Capital Allocation Strategy. Let's take a look at how management is strategically deploying this newfound cash to create some real shareholder value. For those of you keeping a close eye on shareholder return, SEI heavily repurchased its own stock this quarter. They deployed $112.4 million to retire 1.3 million shares. Now, this is what actually helped amplify that massive 38% EPS beat we talked about at the beginning of the explainer. By buying back stock at an average price of roughly $87, they reduced their overall share count by 3%. To me, that shows management is highly confident in their own valuation, and they're fully committed to returning real capital to their shareholders. Which leaves us with one final, pretty provocative question based on their own forward-looking statements. Can SEI actually maintain this incredible momentum and margin expansion through the rest of the year? With major tech platforms converting, alternative investment demand totally surging, and this enterprise leverage finally manifesting, the fundamental building blocks are absolutely all there. But, only time will tell if they can consistently execute at this record-setting pace. Thanks for joining me on this explainer, and definitely keep an eye on how these strategies play out.